Now, friends, let us have some understanding of a point read on heading Common Assumptions of NI net income, comma, NOI net operating income, comma, MM Moody-Gillani Miller and traditional approach. As far as these capital structure theories are concerned, for them, say we are going to understand say certain common assumptions. I request all of you to pay attention. First of all, we'll have the discussion and then shall dictate those assumptions to you. I request all of you to pay attention. First simple assumption is made like this, that all companies all companies have dividend payout ratio 1. That is the first assumption, that all the companies have dividend payout ratio 1. It means that the retention ratio is 0. The assumption is made that say all the companies are having the uniform dividend payout ratio, that is 1. No company say wants to retain anything. That is the first assumption. Dear students, you can very well understand, because of this assumption, the growth rate which we compute as B into R, that is 0 into anything, will become 0. So due to this assumption, the growth rate is 0. That is what we understand. Further, we understand that since entire earning is paid in form of dividend, so the company would have a retained earning as 0. That is the first assumption. Second, assumption is made that say there are only two sources of finance. There are only two sources of finance. First, there is a source of finance called equity, and there is a source of finance called debt. That's it. There are no other sources of finance. We know that say there is a source of finance like preferential capital. However, they have assumed that say, there is no such source of finance. The reason behind that is preferential capital is having hybrid features. Certain features of the equity and certain features are of debt. For example, rate of preference dividend is fixed, which is like debentures. Rate of preference dividend is fixed like debentures. Then we understand that so the payment of the dividend is considered appropriation of the profit and not charge against the profit. So the payment of the dividend considered to be appropriation, which is a feature like equity. Then in certain countries, not everywhere, there is a concept called corporate dividend tax or dividend distribution tax, which is supposed to be paid on preference dividend as well as equity dividend. Then we have practically a situation wherein the debentures and preferences are redeemable. So since it has say the hybrid features, that is the reason say they have eliminated the preferential capital as a source of finance. And since all the companies are having 100% dividend payout ratio, so it is assumed that so the retained earning is 0. That is the second assumption. Third assumption. Third assumption is made like this, that all sources of finance are issued for perpetuity. There is no concept of the redeemable security. Of course, we understand that the equity shares are always issued for perpetuity. However, this assumption is mainly made for the debentures. wherein assumption is made that the debentures are also issued for perpetuity. Fourth assumption. Fourth assumption is made that there is no flotation cost, there is no transaction cost, there is no corporate dividend tax. Dear students, the term flotation cost stands for the cost which is incurred for the purpose of issuing the security. It includes underwriting commission, it includes payment to merchant banker, it includes the advertisement expenses and so on. Basically, friends, what happens at say, if at all you think about a company like Tata Consultancy Services, see when that company is coming with a new issue, it is also required to get its issue under return. Underwriting is mandatory even for TCS. However, say it does not require, it is done, that is correct, but it is not required. Still it is done. Why? Because it is done with an objective to comply with the legal formalities. But that is done only for formality, so underwriting commission will be very less. Because basically underwriter does not have any risk when it is underwriting the TCS issue. In comparison to that, let us say a small investor is there. A small investor is a small company, a small company is there which is recently growing and now it is going for public. In that case, so the underwriting is required because actually there is a threat for that company that say it may happen that so the investors will not respond to you. In that case, the underwriting commission will be substantially high. What I want to tell you is that say the flotation cost in one country is different like this. How it can be same all over the world? And basically these theories are required to be applied all over the world. That is the reason say they assume that say, there is no flotation cost. Then there is a term called transaction cost. Transaction cost means when an investor is purchasing the security from other investor, it is called transaction cost. Assumption is made that say, there is no transaction cost. Understand carefully further that say, the demat account charges is also called transaction cost. Now we know that say even in India, if at all you open the demat account from Sher Khan, you open the demat account from Zerodha, from 5 Paise, from Angel, all over there, that is all of them have say the different cost. So of course, how all over the world transaction cost can be seen. That is the reason say they are eliminating the transaction cost. CDT stands for the corporate dividend tax or dividend distribution tax. Is this a concept that says that when a company is making payment of the equity dividend, simultaneously it is required to make certain payment to the central government. That is called say the corporate dividend tax or it is dividend distribution tax. However, so this concept is not there all over the world uniformly. So again they have made an assumption that it is not there. Fifth point, everybody is requested to pay attention. Fifth assumption is that capital market is perfect. This assumption has two meaning. Meaning number one, information about all companies are available to all investors. In a way that say because of this assumption, there is no possibility of underpricing or overpricing of the security. Then assumption is made that say the capital market is perfect. Means all companies are having, all investors are having information about all the companies. Because of this, there is no underpricing or overpricing of the security. The second assumption, sorry, it has a second meaning that say all investors are rational. All investors are making investment so as to maximize a return and with the minimization of risk. In making any investment decision, I do not take into account any non-financial factor. I always take the financial factors into account, and based on that say I take decision. I give you certain examples. Let us say that say there is a company which imports raw material from China. Looking to the India-China relationship, some investors may not invest in that company. Why? Because that company is indirectly say giving business to China. However, this assumption says that no, it is not like that. You will make investment considering that say are you going to get good return, considering that say whether the risk is low, yes, then you will make investment. You will not keep in mind that say this company is say importing the raw material from China. This assumption says something like this. I give examples. uh, I am Gujarati, so what I will do, I'll make investment in a company say which is promoted by Gujaratis only. I'll not make investment say in any company which is promoted by non-Gujaratis. I don't keep this in my mind. I'll just see that say whatever may be, whoever may be the promoter, whether the promoter is having that potential of generating the business, yes, I'll make investment. Whether the promoter is say competent enough say to do the business successfully, I just take that into account. What is caste, what is religion, so what kind of like the language that say speaks, all I don't care of all these things. I just care for my return. I just care for my risk. This is the way the assumption is made that say all investors are rational for the purpose of making investment. Due to these assumptions, one more thing that I would like to tell you. See what happens that say basically this assumption is made capital market is perfect, so that say there will be competitive market. See if at all uh, I approach to somebody and I ask for the business, let's say you give business to me because I belong to a certain caste or I belong to a certain religion, then in that case what happens that in that case I'll not be focusing on the quality of my service. I'll not be able to focus on the quality of my product. Instead of that say I am focusing on some other area. It should not be the case. I should be able to get the business say with the good quality of the service that I give to my customer. That will make the market competitive. Do not take into account these other factors for the purpose of like decision making. That is what it says. Giving you some more example like this. Say suppose as a student, when you go to let us say any private institute for the purpose of taking admission, and over there you make an inquiry that say how do you recruit your faculty members, then they reply you that say we recruit based on the caste. Then you feel that what is the point of recruiting the faculty member based on caste? Rather you should recruit based on the qualification, based on the experience. Based on that say you should recruit, so that say the really qualified faculty members will be there and they will be able to impart good teaching to us. This is the what the kind of assumption that say they have made. That was first assumption. All companies have uniform dividend payout ratio. That is one. No retention. Full stop. Second, there are only two sources of finance: A, equity; B, debt. With paragraph written down, there are no sources of finance like preference share capital or retained earning. Full stop. Third point, third assumption: capital market is perfect. Full stop. It means all companies have all information. I'm sorry, all investors have all information about all companies. Full stop. Due to this assumption, there is no overpricing or underpricing of security. With paragraph breakdown, further it means that all investors are rational. Full stop. They take decision based on expected risk, expected return, and the risk of investment. Full stop. Their decision is not influenced by any non-financial factor. Full stop. Fourth assumption, there is no flotation cost, comma, transaction cost, and corporate dividend tax. Full stop. With paragraph write down. Above assumption is made to keep uniformity all over the world. Full stop. Fifth assumption, all sources of finance are issued forever. So friends, these are the five assumptions that they have made common in all these capital structure theories: NI, NOI, MM and traditional. So there is a fair possibility that say we will be provided with a theory question. Then in that case, say we are required to write these assumptions first of all. Now, write on new heading, calculation of value of firm and weighted average cost of capital. So now we are going to understand calculation of the value of the firm and weighted average cost of capital. Dear students, the term value of the firm stands for value of equity plus value of debt. Dear students, the term value of the firm stands for total of the value of the equity plus value of the debentures. That is what we understand is value of the firm. So how to make the calculation of the value of the equity and value of the debentures is what I am going to discuss with you. I request all of you to pay attention. Column number 1 is particulars. Column number 2 is answer. Dear students, directly or indirectly, first of all, we would be provided with earning before interest and taxes information. Earning before interest and taxes stands for operating income. This is earning before interest and tax. Less interest. Whatever the debt financing that the company raises, for that it is required to pay interest. So interest will be deducted from it. From operating income, interest is deducted. We have EBT. The term EBT stands for earning before taxes. Then we make calculation of E18, earning after taxes. Now everybody is requested to pay attention. See, we understand that say there is a formula that say we have studied in our chapter of cost of capital, that is given a name as cost of equity formula. It is D1 upon P0 plus growth rate. This is the formula that we have. Now let us understand, listen, that is understand carefully. Now our perspective is to make the calculation of the value of the equity. So I'm rearranging the formula. So it is K minus E is equal to D1 upon P0. So rearrange the formula. So now P0 is equal to D1 upon K minus E. Now what is the G? G stands for the growth rate. And we know that since retention ratio is 0, that is the reason the growth rate would also be 0. So we have a kind of situation like this. P0 is equal to D1 upon K. Minus K does not have any sense. So P0 is equal to D1 upon K. Now the term D1 will be replaced with earning this time. Why? Because the assumption is made that say whatever you earn itself is paid in form of dividend. So the numerator stands for earning divided by cost of equity. And that is the way VE is calculated. VE stands for value of the equity. What is the dividend? Dividend is equal to the earning divided by K, so that will give us value of the equity. Since we already have reached to the earning after taxes, the same will be divided with cost of equity to compute value of equity. It will be found as earning after taxes upon K. Now to value of the equity, we will add value of debt. Dear students, usually, not every time, usually book value itself is market value. Of course, it is not like that, say every time book value is the market value. However, in most of the questions we are going to see like this only. So value of the debt, usually the book value. And then we will have value of the firm. This is VE and this is VD. Value of the firm is this, that is calculated as value of the equity plus value of the debt. And lastly, say we will have the weighted average cost of capital. How to compute weighted average cost of capital? I am explaining that to you. But before that, say we will write this value of the firm table. I request you to write down this table, value of the firm. So dear students, value of the firm is basically calculated as value of the debentures plus value of the equity shares. That is the way it is calculated. Now, how do you compute the value of the equity? For that, set is earning after taxes upon K. That is the way it is calculated. How do you compute the value of the debt? It is, we understand that usually the book value itself is a market value. This is the way we do answer. Now, understanding the weighted average cost of capital. Weighted average cost of capital can be calculated by one of the two methods in this example. That is in this kind of question. The first is, listen carefully, cost of equity into weight of equity plus cost of debenture into weight of debenture. This is the first way by which you can do it. Simple weighted average. There is no preferential capital. There is no retained earning. So it is simple weighted average like this. Or otherwise, you can apply another formula, that is NOPAT, net operating profit after taxes, divided by value of the firm. EBIT into 1 minus T is basically given a name as net operating profit after taxes. EBIT stands for operating income, and EBIT into 1 minus T is given a name as net operating income. That is what we understand. Okay, let us have understanding further. Let's say, how do we have a formula like this for calculation of the weighted average cost of capital? I'm giving explanation that say how do we have a formula like this. Derivation is like this. Listen carefully. Basically, when you simplify this equation, you get this formula. See, for weighted average cost of capital, it is cost of equity into weight of equity plus cost of debt into weight of debt. So cost of equity into what is weight of equity? It is value of equity upon value of the firm. Cost of debt is what? Rate of interest into 1 minus tax rate into weight of debt is what? Value of debt upon value of the firm. Okay. Now listen carefully. We already have got a formula like this. Value of equity formula is this. Value of equity is equal to earning after taxes upon K. So we understand that the earning after taxes is equal to value of equity into cost of equity. So what I am going to do now, value of equity into cost of equity, that I am going to replace with earning after taxes. So earning after taxes upon, you can see that the value of the firm is common. So I am writing value of the firm plus value of debt into rate of interest is interest into 1 minus tax rate. Earning after taxes is what? Earning before taxes into 1 minus tax rate. Earning after taxes plus interest into 1 minus tax rate once again, divided by what? Value of the firm. Now we understand that say 1 minus tax rate and 1 minus tax rate is taken common. So we have earning before taxes plus interest into 1 minus tax rate divided by what? Value of the firm. Earning before taxes plus interest is what? EBIT. Earning before interest and taxes into 1 minus T upon value of the firm is what we understand is the weighted average or overall cost of capital. This is the way we have the formula. EBT plus interest is what? EBIT into 1 minus T is what? Like net operating profit after taxes. So only over here we can have this formula. This is not the general formula that we can have. So derivation is only for understanding purpose. So we have studied two things. How to make the calculation of the value of the firm. That is what we have studied. And we have studied calculation of weighted average cost of capital. To compute the same, we have understood both the methods. One is what we already know and another is a new method. The written heading, net income approach. In bracket I am writing NI approach. Let us see a question. Company X and company Y are identical in all respect, including risk factors for debt and equity. X having issued 10% debentures of rupees 18,000, Y has issued only equity. So X is a levered firm and Y is unlevered firm. Both the companies earn 20% before interest and taxes on their total assets of 30,000. So assets of the company is 30,000 and they earn at the rate of 20%. Assuming a tax rate of 50% and capitalization rate of 15% for an all equity company. It means that the weight of equity is 1. In that case, cost of equity is 15%. All equity stands for an unlevered firm. So in this example, we understand that the question is providing the information that X is a levered firm. Levered means a company which has introduced debt financing, and Y is an unlevered firm. Unlevered stands for no outsiders financing. So this cost of equity of 15% is given for company Y. The question says that a compute value of the company X, value of the company Y, overall cost of capital like of both the companies using net income approach. The term net income stands for NI. You are required to make calculation under two assumptions. If taxes are not there and if taxes are there. That is the question. I request all of you to go through the question and then we'll discuss how to do it. Let us understand how to calculate answer of the question. Heading right down. Calculation of value of the firm and weighted average cost of capital using net income approach. So we are going to compute the value of the firm and weighted average cost of capital. We'll do answer in two ways. Tax, no taxes and with taxes. We'll do answer for company X, company Y, company X and company Y. That is the way we are going to do answer. We understand that the earning before interest and taxes. It has been provided that say assets of the company is 30,000 and the rate of earning of the company is 20%. So 20% of 30,000 that comes to 6,000. We know, dear students, that say from operating income interest is deducted, then we get earning before taxes, minus tax we get earning after taxes, divided by cost of equity, that gives value of equity. Whatever the value of the equity that we have, to that say we add the value of the debt. In case of the value of the debt, usually the book value itself is the market value. That is what we understand is VD. Then it is value of the firm, which is calculated as value of equity plus value of debt, is value of the firm. And lastly, it is weighted average cost of capital or overall cost of capital. This is the way we are required to prepare the simple table. I request you to do answer for company Y in a situation of no taxes and put your answer in the chat box. I repeat my question. I want you to tell me answer that say what would be the value of the company Y and its weighted average cost of capital in a situation of no taxes. So now as far as the company Y is concerned, in that so the amount of the interest will be taken as 0. Why? Because it is an unlevered firm. Earning before taxes is 6,000. We are in a segment of no taxes. So EBT and EAT will be same 6,000. Cost of equity is provided for an unlevered firm, it is 15%. So value of the equity is 6,000 divided by 0.15. So 6,000 divided by 0.15. That comes to value of the equity is 40,000. Value of debt is 0. Why? Because it is an unlevered firm. Value of the firm would be 40,000 and weighted average cost of capital will be 15%. Why 15%? Because there is only one source of finance. So whatever is the cost of equity itself is the weighted average cost of capital. Now friends, I want you to keep some space below the table and I am dictating a note to you. I want you to read that note and then complete the answer for company X. I repeat my point. I want you to read that note and complete the answer for company X. So write down a note. First point, NI approach has made an additional assumption that cost of equity will remain same irrespective of proportion of debt financing in capital structure. Full stop. Second point, due to above assumption, comma, as per NI, a company should introduce debt financing so far possible so that A, WACC reduces and B, value of firm increases. Now I want you to read this note. I'll explain that to you later on. And I want you to complete answer for company X in a situation of no taxes. So now friends, EBIT is again an amount of 6,000 because both of them are having same assets. X is a levered firm, so the debt financing is 18,000. The rate of interest is 10 percentage. So the amount of the interest expense is 1800. EBIT minus interest is EBT 4200. EAT 4200. Very importantly, the assumption made by the NI is this, that irrespective of the proportion of the debt financing in the capital structure, cost of equity is going to remain same. So this is an assumption that they have made. So what will happen, dear students? We have to take the cost of equity of company X equal to company Y. That is 0.15. Sir, what will be the case in other capital structure theories? That we are going to discuss over there. But when the question says about the NI approach, we have to follow this assumption. So value of the equity will be 4200 divided by 0.15. That is the way we'll make the calculation of the value of the firm. 4200 divided by 0.15. That comes to 28,000. Value of the debt is assumed to be equal to the book value of the debt, 18,000. So value of the firm is 46,000. Weighted average or overall cost of capital is supposed to be found. For that, we have said two methods. WACC for company X. For that, say we have two methods. The first method is earning before interest and taxes into 1 minus T divided by value of the firm. What is earning before interest and taxes? 6,000 into 1 minus 0 divided by value of the firm is 46,000. Okay. So what will happen, it is 6,000 into 1, that remains 6,000 divided by 46,000 into 100, that is 13.04. This is the way we make the computation of weighted average cost of capital, 13.04. Okay. At the same time, if at all you want to do with the routine formula, even in that case you can do it. In that case, what will happen? First of all, you will calculate the KD. It is rate of interest into 1 minus tax rate. What is the rate of interest? Rate of interest is 10 percentage. Yeah. Income tax rate is 0. So it is 10 percentage. Now, weighted average cost of capital is cost of equity into weight of equity plus cost of debt into weight of debt. That is the way we'll have the weighted average formula to be applied. Cost of equity is 15 percentage. Weight of equity is 28,000 upon 46,000. Cost of debt financing is 10 into 18,000 upon 46,000. So now we'll have the working of the answer like this: 28 upon 46 into 15, that comes to 9.13. 18 upon 46, 0.39 into 10 is 3.91. So 9.13 plus 3.91 is 13.04. This is the way weighted average or overall cost of capital will be calculated. Okay. Now see, the answer is over. Now we are going to have a conceptual discussion. See, basically what happens at say, as far as the NI approach is concerned, NI approach has made very surprising assumption. As I told you that say when we are going to understand any of the theory, we just have to follow the explanation that they have given. So they have made a very unique assumption over here that irrespective of the proportion of the debt financing in the capital structure, cost of equity will remain same. Generally, this is not true. Whenever there is an increase in the debt financing, risk for the equity shareholder increases, so that expectation also increases. But they have made assumption that cost of equity will remain same. We know that said definitely cost of debt financing is lower than the cost of equity financing. So when you go on introducing say the debt financing in the capital structure, it means that you introduce a source of finance which is having lower cost. So what will happen when you introduce a source of finance which is having lower cost? It will have an advantage of reducing the weighted average cost of capital. It will have an advantage of reducing the weighted average cost of capital. That is what we understand. So see, the note that I have dictated is like this. NI approach has made an assumption that cost of equity will remain same irrespective of the proportion of the debt financing in capital structure. Second point that I have dictated, due to above assumption, because of this assumption, as per NI approach, a company should introduce debt financing so far possible, because more and more debt financing will have the reduction in the weighted average cost of capital. Numerator NOPAT is going to remain same, so obviously the value of the firm will go up. I hope everybody is clear with that. We have understood a formula like this. Weighted average cost of capital is EBIT into 1 minus T upon value of the firm. So value of the firm is equal to EBIT into 1 minus T upon weighted average cost of capital. So whenever there is a reduction in the weighted average cost of capital, with that the value of the firm will go up. That is what we understand. Now friends, over here we are going to understand further a diagram. This diagram is again not forming part of the answer. However, there may be a theory question that would be asked in examination. In that say, all these things will help you to improve the quality of your answer. On x-axis we take debt financing in capital structure. And on y-axis I am taking the cost of capital. I draw one line for you, that is the cost of debt financing. I am giving you some time. Plot two lines which I have kept pending. One is cost of equity and another is the weighted average cost of capital. So friends, over here there are two things yet to be plotted. One is cost of equity and another is the weighted average cost of capital. See, the assumption is made that the cost of equity will remain same irrespective of the proportion of your debt financing. So this is the line of cost of equity. Okay. And now when you introduce the debt financing, what will happen? You get the advantage of the lower cost of the funds, and because of that weighted average cost of capital is falling down. This is WACC, weighted average cost of capital. This is the way we are required to show the diagram. And of course, all of you can understand very well, this weighted average cost of capital line will not touch cost of debt line. Why? Because there cannot be 100% debt financing. That is the reason. Now, these two working, try to complete on your own with taxes for company X and company Y. The same thing is there. The only thing is that say you're required to now consider the tax. Try to complete both the columns on your own. Let us complete this very simple answer. Now, this is again 6,000. Amount of interest is 0. This is 6,000. This is again 6,000. Oh, I'm sorry, it is 3,000 because tax rate is 50%. Cost of equity is 15%. So it is 3,000 divided by 0.15. That comes to 20,000. Value of debt is 0. Value of the firm is 20,000. Weighted average cost of capital is 15%. For company X, again 6,000. This is 1,800. This is 4,200. This is 2,100. This is assumed to be same, 15%. 2,100 divided by 0.15. That is 14,000. Book value and market value is same, 18,000. This is 32,000. Again, you can compute the weighted average cost of capital by one of the two methods. The first method is like this. Working note number 1. Calculation of KD. It is rate of interest into 1 minus t. It is 10% into 1 minus 0.5. That comes to 5%. Next, calculation of WACC. Cost of equity into weight of equity plus cost of debt into weight of debt. What is cost of equity? Cost of equity is 15%. What is weight of equity? It is 14,000 upon 32,000. What is cost of debt? 5. What is weight of debt? 18 upon 32. That is the way we'll have the answer. It is 14, 18 and 32. So, we understand that it is 14,000 upon 32,000 is the weight of equity into 15. So 6.5625. 18 upon 32 into 5. 2.8125 plus 6.5625. 9.375. That is the way weighted average cost of capital can be calculated. Or otherwise, earning before interest and taxes into 1 minus t upon value of the firm. What is the amount of the operating income? 6,000. What is income tax rate? 50%. What is the value of the firm? It is 32,000. So what will happen? 6,000 into 1 minus 0.5. That comes to 3,000. 3,000 divided by 32,000. So 6,000 into 0.5 divided by 32,000 into 100 is 9.375. Either of the way you can present your answer, it is definitely acceptable in examination. So again we can see that, say, as per the NI approach, with the introduction of the debt financing, weighted average cost of capital reduces and value of the firm increases. This is 9.375. This is the way we do answer. This is NI approach. Calculation, conclusion, and the important diagram.